Okay, so picture this. A massive, multi-billion-dollar economy that runs on nothing but cash and a handshake. Sounds crazy, right? Well, today we're going to unpack the incredible story of how just one brilliantly simple law managed to bring this entire hidden world out of the shadows.
And that really is the central question, isn't it? How do you even begin to tax a billion-dollar market that's, well, completely invisible? When an entire industry operates off the books, how do you bring it into the light? Turns out, the answer is all about finding the system's one single weakest link.
So to really get our heads around this, let's take a trip. We're heading to a real-world example, the massive, absolutely bustling Chandni Chowk garment market in Delhi. I mean, this place is legendary. It's pretty much the wholesale hub for the entire country.
Now, the shops here, they do a phenomenal amount of business. We're talking crores, millions upon millions of dollars. But here's the kicker. Historically, it all happened in this sort of parallel financial universe. Goods were bought, goods were sold, but not a single bill was ever written down. This meant all that economic activity was completely invisible to the tax authorities.
So what's the engine powering this whole shadow economy? It's a financial tool called a hundi. Think of it as an informal, under-the-table bill of exchange. And to really understand how the hundi was being misused, we first have to get familiar with its legit, by-the-books cousin.
So what is a bill of exchange? It's basically a formal, legally recognized IOU. It's a written promise that says, hey, I owe you this much money and I promise to pay you back on this specific date. It's really a cornerstone of how modern credit-based trade works.
Okay, so let's walk through how this works in the official system. A seller gives a buyer some goods on, let's say, 60-day credit. The buyer, in return, gives the seller a formal bill of exchange. Now, the seller might need that cash right now, so they can take that bill to a bank. The bank looks at it, trusts the buyer is good for the money, and discounts the bill. That means they give the seller cash immediately, just minus a small fee. Then, 60 days later, the bank goes and collects the full amount from the original buyer. See? It's clean, it's traceable, and every single step is on the books.
All right, so we've seen the legal way. Now let's flip the coin and see how this exact same process is mirrored in the shadow market. This is a system that operates completely outside the banking world, and it's all fueled by untraceable hard cash.
In this little drama, we've got three main players. First up, you have the garment shop. These are often family businesses with generations of goodwill and trust built up in the market. Then there's the agent, the middleman who's selling the goods and desperately needs to keep his cash flowing. And finally, the hundi dealer. This is a wealthy person who basically acts as an unofficial, totally unregulated bank.
So here's how the shadow system works, and this is the crucial part. The agent sells goods to the garment shop on credit. The shop gives him a hundi, just a simple piece of paper promising to pay up in, say, 60 days. The agent, needing money now, takes this hundi to the hundi dealer. The dealer, who trusts the shop's reputation, hands over a massive bundle of cash, minus his fee. Then, 60 days later, the shop pays the agent in cash, and the agent takes that cash to repay the hundi dealer. See the loop? Not a single rupee ever touches a bank account, and of course, zero taxes are paid.
So, the government is facing this massive, totally invisible cash loop. What do? Well, they came up with an incredibly clever, almost elegant solution. They didn't create some complicated new system. They just introduced one single, powerful rule. Section 69D of the Income Tax Act.
The law itself is actually pretty simple. It basically says this: if you borrow or repay any money using a hundi and you do it with anything other than a very specific kind of check, an account payee check, then that entire amount, the whole chunk of cash, will be counted as your taxable income for the year. That's it.
And this is where the strategy is just brilliant. The government didn't go after the powerful established garment shop owners. They didn't go after the cash-rich hundi dealers. Nope, they targeted the weakest link in the chain, the agent. Think about it. The agent is the one who needs that immediate cash flow to survive. By threatening to tax his entire transaction as income, the government put this incredible pressure squarely on him to change how he did business. But you might have noticed, the law is very specific. It doesn't just say pay with a check. It says pay with an account payee check. So what's the big deal? Why is that tiny detail so important? Why was that the key to breaking this whole system wide open?
Well, this really breaks it down. See, a bearer check is pretty much like cash. Anyone holding it can cash it. Almost no traceability. A cross check is a bit better. It has to be deposited, but it can be passed along so the trail can get murky. But an account payee check? Ah, that's the magic bullet. That can only be deposited into the bank account of the person whose name is on it. Period. It creates a clear, undeniable paper trail, forcing the whole transaction right into the formal banking system.
So by mandating this one specific type of check, the government essentially created a fork in the road. You could go down one path into the formal, taxed economy, or you could try to stick with the old cash system. But that other path, well, it now came with a penalty so severe it would basically wipe out your entire business. And this, my friends, is where the 78% tax hammer comes down.
So how do you make the old way completely impossible? You start with a massive base penalty. If you get caught dealing in cash, that entire amount is taxed at a flat, no excuses rate of 60%. Boom.
But wait, they didn't stop there. Oh no. On top of that 60% tax, they slapped on a mandatory surcharge of another 25% of the tax amount.
And just to top it all off, you throw in a final 4% cess. You add all that up, and the total penalty becomes absolutely, unbelievably crushing.
The final result? A staggering 78% effective tax rate. Let that sink in. For every 100 rupees you handle in cash, 78 of them now belong to the government. All of a sudden, operating in the shadow economy isn't just risky, it's completely unprofitable.
And what if you think you can get away with it? What if you don't come forward and a tax officer catches you? Well, it gets even worse. They tack on another 10% penalty, pushing the total effective tax rate to a crippling 84%. At that point, there is literally zero financial incentive to hide anymore. The game is over.
And that really brings us to the key takeaway from this whole thing. Can a single, cleverly written law really tame a multi-billion-dollar shadow economy? Well, this is a powerful example of how smart regulation can work. You find the weakest link, you create an unavoidable choice, and you make the penalty for breaking the rules so high that it's just not worth it. It kind of proves that sometimes, to solve a really complex problem, you don't need 100 new rules. You just need one much, much smarter one.